You know what? You won't believe it. PDD's growth is that of Alibaba. And guess what? PDD's PE ratio is only of Alibaba. It's crazy, right? As you all know, PDD stock price dropped 30% within only a few days. And my question is, if I have $1,000, whether I should invest in PDD now or maybe Alibaba is a better option. If this is the first time you're here, my name is Eric. I've been investing since I was 18 years old for more than 20 years. Yeah, I know, I can't believe that. I look quite young. Anyway, I invest in all kinds of products, stocks, ETFs, bonds, warrants, options, watches, you name it. So if you want to know more about my investment ideas, especially with Chinese stocks, or you want to know about my 200 plus business ideas, which I'm going to share for free, remember to subscribe now. As many of you know, PDD stock dropped 30% within a few days. Well, obviously many would ask, if I have $1,000, should I speculate or invest in PDD now for a quick profit? Or maybe Alibaba is a better option? I'm going to give you the comparison. In this video, we're going to focus on 3 components to compare Alibaba and PDD, whether we should invest now to make a quick profit or not. The first thing is about growth potential of both companies. The second one is to compare the financials, for example, PE ratios. Last but not least, we look at the business models. And then I will draw a conclusion, and then of course we can discuss together whether it makes sense or not. If you think about the stock prices of Netflix, Tesla, Alibaba, or even Meta or Facebook in the past, what do they have in common? They went up 50%, 500%, 1000%, sometimes, a few hundred times up within a few years or even within a few months. And what do they have in common? Growth rate. They need to sell the growth story. That's exactly why we start looking at the growth potential of both PDD and Alibaba. Okay, let's look at the growth rate. Let's start with Alibaba. The growth rate among the consensus of the analysts is that the next year would be around 7%. 7% seems not super, but given that Alibaba is a huge company, 7% is still a respectable figure. Of course, you cannot compare with Alibaba in the past, like last 10 years, right? How about PDD? PDD's expected growth rate among the consensus of analysts is around 19%, 19, which is pretty high. Of course, you cannot compare before like 80%, year on year. This is impossible because this is not sustainable to be 80% every year, right? So 19% is still a very high figure. We're talking about 2 or even 3 times that of Alibaba. After talking about growth rate, very important is to compare the financials between Alibaba and PDD. So we usually look at price to earnings ratios, PE ratio. If you don't know what is price to earnings ratio, check out the links above in my former videos. But in simple terms, basically is the ratio between the share price divided by the earnings per share. For example, if the share price of this company is $100 each, the earnings per share is $10. You have 100 divided by 10, then you have the price to earnings ratio of 10. And companies with the high growth potential, or at least the story is selling high growth potential, like Netflix, Tesla, or in the past, Facebook, they usually have very high PE ratios because you're expecting them to grow a lot, so does the earnings, right? So if the earnings are forecast to grow a lot in the coming few years, then people would tolerate that the price, basically the share price, would be a much higher ratio compared with the actual earnings per share. Let's start with the price to earnings ratio of Alibaba. It's around 22 at the moment of this video, but guess how much was the PE ratio of Alibaba in its heyday? It was 120. Yes, you didn't hear wrong. 120 price to earnings ratio in December 2022. So it's crazy, right? So you can imagine a growth company with a growth story can have a PE ratio up to 120. Amazing. And guess what is the PE ratio of PDD? 10. Yes, you didn't hear wrong. 10. After the 30% drop of the share price, the PE ratio of PDD is only 10. So imagine Alibaba with a 7% growth rate still has a PE ratio of 22. And PDD's growth rate is almost 3 times that of Alibaba. That means you translate it to PE ratio could be up to 60, right? That means that the share price in theory can go up 6 times to PE ratio 60. Okay, so we know about the growth rates, we know about the financials, the most important part. How about the business models? What kind of business do they do and how do they earn money? Let's start with Alibaba. Alibaba is very diverse. So first of all, they have their flagship Alibaba, which is their e-commerce platform B2B, so business to business. Basically, if you are an entrepreneur, you look for some goods. For producers in China, they have a platform. You go to Alibaba.com and then you can find the manufacturers. They also have similar things, AliExpress for outside of China, so that you don't need to clear your customs, pay import tax, that kind of things. But of course, it's more expensive. And then e-commerce, they also have B2C, business to customers, which is Tmall. So basically, it's a little bit Amazon, like kind of a company selling to customers through the platform of Tmall. And then they have something called C2C, which is quite new, customer to customer. So kind of a little bit like peer-to-peer. A customer selling things to another customer like eBay, but also for smaller companies, they can also sell stuff through the C2C platform. The C2C platform is called Taobao, which is super famous if you know anyone from China. But this is not it. They also have other business. For example, Ali Cloud, the cloud business. In China, you don't have many choices. You cannot really choose Google or Microsoft. So most cases, you choose Ali Cloud or its competitor in China, which is a Chinese company as well. And then they have logistics companies just to serve the platform I mentioned before, the e-commerce platform like Alibaba. And then they have the finance arm, which is a very big finance company doing banking, micro-insurance, and also payment. If you've been to a touristy spot in your country, most likely you will see Alipay if you pay attention. Next to MasterCard and also Visa card, there's a logo called Alipay. So this is one of the 2 payment systems that are most commonly used in China. So even beggars will not accept cash in China nowadays. I'm serious. Only Alipay or its competitor WeChat Pay. How about PDD's business model? What do they do? It's relatively simple. They only have 2.5 business, I would call it. The first one is Pinduoduo, so that's why PDD. Pinduoduo is a platform for group purchase of goods. They kind of like Groupon, but they gamify it so that you kind of have a team together and fight for something cheap. So the business model is have a platform selling something super cheap, kind of like Groupon, group purchase. The second one is Temu, T-E-M-U. You've probably seen it in the States or in Europe. It is crazy cheap. They have unbelievable prices. They are selling at a loss sometimes. That's why you see something super cheap like $2 for something that should worth $20 usually. And this is the second business. So this is basically what they call the C2M business, consumer to manufacturer business. So basically connecting consumers like you and I to manufacturers directly on their platform. So the profit margin is very low, but if you have scale, you have crazy cheap prices, many people buy through Temu, then they can generate some profits. The half business I'm talking about is the agriculture business. So it's technically the third business they have, but I would say that the ticket size is very small. They also need to do it at scale in order to make any profits. So if you compare the business models of PDD versus that of Alibaba, PDD has a very narrow business models. Basically, it's B2C platforms selling goods at very low price. In some cases, also the reputation is not too good because obviously low price, the quality is not that high either. So it's Pinduoduo, the group purchase platform at low price, and also Temu internationally has a relatively bad reputation in terms of quality. Obviously, if you sell $2 for something that usually sold for $20, the probability cannot be very high. Second point is that Alibaba's business obviously is more diverse in terms of e-commerce. Even within e-commerce, they have B2B, B2C, C2C, customer to customer. And then they have cloud, they have logistics, they have financials. So it's a broader, more diversified portfolio. And the third point is that this would also lead to more synergies in Alibaba across the different platforms. They can refer customers to different platforms or basically keep all of them among their platforms. So people actually never leave the ecosystem of Alibaba in some cases. And the fourth point is that also they can save costs to increase profit margin, not only because they have a broader business model with a broader audience and customers, also because they can verticalize. So basically, for example, if they have cloud, which is also serving its platform, they don't need to pay external providers at a higher price. And then they have logistics as well. Logistics obviously is serving their e-commerce platforms, which means that they can also save cost and run the e-commerce platform and logistics at scale at a low price. And the most important point is that how sustainable is PDD's business model in the longer term? First of all, you're focusing just on lower price at scale. So what if someone else is doing the same? Secondly, the thing is that if they have a bad reputation for quality and customers are not returning after 1 or 2 years, then the growth would go down because at the beginning you say super cheap, I want to buy something, and then you realize, okay, actually it doesn't work. Then you start to lose customers. And for Alibaba, the business models is obviously more sustainable because it is building an ecosystem covering everything. To wrap it up, if I have $1,000, am I going to invest in PDD now because it has dropped 30%, or I would rather wait for Alibaba? If we talk about short-term profit, like at least 50% within the coming few weeks or coming few months, definitely PDD. Why? Because the growth ratio is much higher than Alibaba. We're talking about almost 3 times higher. Growth story is always the trigger for most of the cases when you hear Netflix, Tesla, or Alibaba in the past, why the stock price skyrocketed. It's always about the growth story. The second point is about financials. The price to earnings ratios of PDD is so low, we're talking about 10. Such a growth company has only PE of 10 after dropping 30% in stock price. This is a once-of-a-lifetime opportunity to buy so cheap. Of course, the growth rate might be slower in the coming few months, but still the PE ratio of 10 is still super low. Even Alibaba with such slow growth rate still has a PE of 22. But of course, if you talk about you want to keep the stock for 5 years or even 10 years for long-term investment, then Alibaba is definitely the much better choice because it has a much more diverse portfolio of business, and also it has proven that its business model works. Because PDD, remember, is still a very young company. We're talking about a few years' time, even much younger than Alibaba. So if you want to sleep well and don't want to have the fluctuations, however also less profits, then Alibaba for the long term is probably much better than PDD. Do you agree with my assessment? Leave me in the comments below. Also, before you go, one very important thing, 90% of you are not subscribed to the channel, and actually the subscribe button and the like button is for free. You can't imagine how much it can make a difference for me to keep doing these videos. So remember to subscribe and click the like button now. Thank you. See you next time.